Hello everyone, welcome again. Now in the last video we talked about call and put options. Now before we proceed any further, I want to take you to this website cboe.com, Chicago Board of Option Exchange, and I want to show you what an option chain looks like. In front of me I've opened HP, which is currently trading at $39.14, and this is what an option chain looks like right now. This is the option chain for which is expiring in October. These are various strike prices. These are different headings, which for the sake of simplicity I would like you to focus on this column over here. So what it says is there's a call with a strike price of $36. Last trade was $3.50 for a strike price of $40. It's selling, or you can do the trade at 87 cents. So on the left hand side are the calls and on the right hand side are the puts. And if we go down further, this is the option chain for November. This is what it looks like. $37 call can be traded at $3.25. $37 put can be traded at $1.05, and so on. So this is what it looks like. If you go down further, there is a chain for January 2011, February 2011, January 2012, and so on. And on the left you will see this is the nomenclature. There is a complex method to this nomenclature which we would not be talking about now. So in the last video we talked about what buying and selling a call option looks like. In this video I would talk about what selling a call option looks like. So here it is. This is a call option we are talking about, and there is a buyer on this side and there is a seller on this side. Now, as we talked about in the last video, the buyer, it says, I have the right to buy. He says I have the right to buy if my stock price is goes up then my strike price. This is where the trade would be profitable for me. So I have a right to buy if my stock price crosses the strike price. So where does it leave the seller? It says, okay, if you have the right to buy and if you decide to buy, I have the obligation to sell. So buyer has a choice. If the trade is not profitable, if he feels like the trade is making a loss, he can decide, because he has the right to buy, he can choose either to make the trade or not to make the trade, and he will just be, his only expense would be the money that he has put into a trade. But for the seller, he has no choice, he has the obligation. So if the buyer decides to make the trade, the seller will have to make the trade. Similarly, in case of a put option, there's a buyer says, I have the right to sell. I have the right to sell it to you. And where does it leave the seller? It says, okay, if you decide to do so, I have the obligation to buy. So again, the buyer of a put option, he has a choice depending on whether the trade is profitable or not. He can decide to make the trade. He can exercise his option. But if he decides to exercise the option, the seller has no choice. He will be obliged to do that trade. Now if you look at it, the buyer and seller have opposite interests. So what makes in both the cases, in the case of put option, in the case of call option, the buyer and seller are on opposite ends. So what makes sense for the buyer does not make sense for the seller. What makes sense here for the buyer doesn't make sense for the seller over here. So what will happen? So remember, if you remember from the last video, the buyer of the call option, he wants the price of a stock to go up. He is bullish. His position is bullish. He wants the price to go up. And what happens with the seller? If the price goes up and the buyer executes the trade, the seller will lose money. So seller wants the price to go down, and his way of looking is he wants the trade to be, he wants the stock to be bearish. And in the case of a put option buyer, he wants the price to go down. He is bearish. And so what would be the case for the seller? He wants the price to go up, and he would be bullish. So again, what makes sense for the buyer doesn't make sense for the seller. If the buyer, you would have to just look at it at one perspective, and the other one would be negative. So if the call buyer is bullish, the seller would be bearish. So let me demonstrate by this graph over here. So this is the graph for the buyer of a call option. This is the profit, this is the loss, this is the break-even line, and in this direction we have the increasing stock price. So if you look at it, it says as we go from left to right, as the stock price increases, the profit for the buyer of a call increases, and the higher it goes up, the more will be the profit for the buyer of a call option. And so he has an unlimited profit potential. Unlimited profit potential. And on the other end is the seller of a call option, and this is again increasing stock price, this is profit, this is loss. And so what's happening over here? As the stock price is increasing, things are looking bad for the seller of a call option. So if the stock price keeps on increasing, the seller of a call option has unlimited potential for loss. Unlimited potential for loss. So what was working for the buyer of the call option is not working for the seller of the call option. And this is the if the price, this is the strike price. If the stock price remains below the strike price, if the stock price goes down, this is the profit margin for the seller of a call option. And you can see no matter how low the stock price goes down, the profit margin, the profit potential for the seller of a call option will always stay the same, whereas the profit potential for the buyer of a call option will increase as the price of the stock increases. Again here, look at the situation, what happens in the case of a put option. Now this is the graph for the buyer of a put option. If if you remember, the buyer of a put option, put, he is bearish. Put, he wants the stock price to go down, and if you look at his graph, you see that as the stock, and this is increasing stock price, increasing stock price. As the stock price increases, he's losing money. This is his loss. And as the stock price increases, yes, I was right, and as the stock price goes down, his profit is increasing, and as the further it goes down, the more the profit is for the buyer of a call option. So he has a put option, and so he has unlimited profit potential, and he has limited loss here. He can only suffer limited loss, and that limited loss is the amount of money he has paid to buy the put, but his profit potential is unlimited, and the further the stock goes down, the more profit he will have. And if you look at the opposite side, the seller of the put option, he wants the stock price to stay up. This is the strike price. This is the strike price at which the buyer of the put option bought this put, and if you look at it, this is the profit potential for the seller of the put. If the stock price is higher than the strike price, he has a profit here, and which is limited to what the amount he got for selling this option. But if the price of the stock goes down, he can suffer unlimited loss. So again, just to say, the buyer and the seller are in the opposite ends. The buyer of the call option says, the buyer of the call option says that I have the right to buy, and he will only buy when the stock price goes above the strike price, where it'll make sense for him, and he has the right to buy, but the seller has the obligation to sell to him. In the case of put option, the buyer has the right to sell, and the seller will have the obligation to buy from him. And so this is buying and selling a call option, and we'll talk more about this in the next video.